From Echelon Capital recently released a research note in CloudMD. I found this research note, or the bits I could find about it, quite helpful to update my numbers in CloudMD for next year. So I want to go through a little bit of what I learned from him, and then my new research and my fully updated numbers for next year, largely matching Rob's. So in my previous video, I just had question marks for digital health services and clinics and pharmacies. I also forgot to include debt in my enterprise value, so I'll update that at the very end of the video. First thing I want to highlight from Rob is his enterprise or EBITDA positive prediction. He's hoping for that in the first half of 2023. CloudMD's MD&A predicts this for the second half of the year. So hopefully CloudMD is under promising and is going to over deliver. At least that's what Rob is believing is going to occur. What I found most beneficial from Rob's numbers is his revenue for this year, 165-ish million, and more interesting, 174 for next year. I was thinking the revenue number was going to be much lower, and I was underappreciating some pieces that I now think I'm more appreciating. He lists this as a speculative buy. Cloud has been a top pick for Echelon Capital for probably well over a year now. I don't put much weight in these price targets, but I do in his research. So I try to find anything else from Echelon Capital and Rob online. Their website has their Q2 top picks, and the video that they have, CloudMD, is the very first part of that video. He largely talks about the benefit of the Sun Life connection with Cloud and how they can potentially do a lot of cross-selling, and how the customer cost of acquisition is so low when you cross-sell, it's essentially zero, so very beneficial to a company. Echelon Capital also had some old research notes that were publicly available on the internet. There's obviously more recent notes, but they're behind a paywall, so anybody can find their July 4th, 2020 research note, and the link is at the bottom. This research note had this fabulous slide of all their acquisitions as of July 4th of last year. It really let me focus my research on where is some revenue that I'm underappreciating. So one was the ReFunction Health Group with about 6 million in yearly revenue. It does give some numbers on that South Surrey medical clinic that they sold to try to figure out how much revenue they might have lost. And I was underappreciating Vision Pros and the previous 22 million per year run rate that they had in 2020. There's lots of enterprise health services acquisitions that they made. One particularly large one, but I'm not going to go into any of these. I'm just going to use Rob's 15 to 20% revenue growth that he hopes that enterprise health services had. I previously was being a little more conservative with about 12% growth. That same research note did talk about his organic growth hope, and that's a previous mention, 15 to 20% for enterprise and 15 for digital. So I kind of updated my models using his numbers, a little bit more optimistic than I was using. So the first thing I dived into was the clinic and pharmacies, and I was assuming that most of the revenue would be going with the sales. But as far as I can tell, this ReFunction group of clinics is still there. I did a lot of digging and didn't find a lot of information, but I find nothing that tells me that it was included in any of the sales. One issue, I had a big problem finding information going back to last year's MD&A. They talk about their clinic and pharmacies, digital health services, and enterprise. it was in the opposite order back then that it is today. And the ReFunction Health Group was explicitly talked about in Q1 of last year. By Q2 and Q3, there's no mention of this ReFunction Health Group. It's just buried in this rehabilitation clinics. I can't find any details in any of the MD&A about this group. But I also have no reason to believe it's sold. So I'm assuming it's still part of CloudMD. When I go to their website, as of November 10th, 2022, it's still branded as CloudMD. Everything that was sold to Well has already been rebranded as Well on their website. So if this was sold to Well, it would be rebranded like everything else that Well acquired. The clinics now direct you right to the Well website. The next thing I really had to focus in on is Vision Pros, and I think I have a much better projection going forward and understanding of Vision Pros Canadian and US revenue. So they used to have $22 million in revenue in 2020 before Cloud bought them. They had this big problem in the US. They had to stop selling. One benefit of the non-selling into the US is it let me know exactly what their Canadian sales are. And I was able to break down the Canada-US sales ratio going backwards. So in their Q1 2022 MD&A, they actually list, they don't do this in most of their financials, they list a Vision Pros revenue of $2.7 million. Now the US sales were not happening, so I'm now pegging this as the Canadian Vision Pros amount. Okay? And then I'll go back to previous quarters using this number and the total that is Vision Pros and figuring out the US side. So 2.7 million in Q1 of this year. In Q2, I tried to find a number. They didn't list it, but they said company Vision Pros couldn't sell into the US. So we've got Canadian sales only, and the sales were relatively, or the revenue was relatively unchanged. So in Q2, if Q1 was about 2.7, Q2 was also about 2.7. So we'll see that in my model shortly. So this is my model, and I'm now breaking out digital health services and digital health services into two pieces. I've got VPs, my Vision Pros. The blue numbers are all actual numbers from CloudMD filings. Anything yellow would be numbers from me. So we've got 2.7 million for Q1 and Q2, and I'm labeling that as Canadian Vision Pros when I work backwards into last year. And then I have the revenue from the other parts of digital health services, so in the low to mid 3 million range. I took that 3.2 from Q1 of this year, and I assumed that the revenue was roughly the same in Q3 and Q4. These numbers are actually probably slightly high. Okay. But when I take the digital health services revenue, which is blue, that we know, this is from their press releases, take away what I'm guessing is a slightly high number for the other, we get Vision Pros revenue. So in Q4, before the US shutdown, it was a little over 7, and in Q3, slightly under 7. So if we know the Canadian sales were about 2.7, the US sales are a little over 4 for Vision Pros. So this is, pegging total Vision Pros at about 7 million per year. So that's a higher run rate than it had in 2020, which is a good sign that Vision Pros was growing. So that's looking back into the past. Understanding the past, let me help model the future. So going forward, I have to take out some revenue. These are definitely some educated guesses, and I'm very open to comments on this video if you can help me improve my lost revenue projection. So from Well, they sold 2 clinics. So So the South Surrey, we had that information from that previous slide. So that was 3 million in revenue when they bought it. So 3 million divided by 4 quarters is $750,000 per quarter. So I'm assuming both clinics maybe are about the same. So I'm taking $1.5 million of revenue-ish off clinics and pharmacies for sales for what they sold to Well. Digital health services, that's all the software that they sold, Clinic Aid. Really not sure what that is worth. I'm taking off $1 million per quarter. Hopefully that's a high number, really totally a guesstimate. Neighbourly lost revenue, also had to do a lot of guessing here. The 2 pharmacies, I'm assuming they were sold for one-time revenue or using a pessimistic projection. So if they were sold for 3.8 million one-time revenue, they'd be making 3.8 million per year, so about 1 million per quarter. And this number could be much less if they got, let's say, 2 times revenue for those clinic and pharmacies. So these are the numbers I'm using going forward to take away from digital health services and clinics and pharmacies. So I'm going to go back to my revenue. So in Q3, we've got some lost revenue from Ontario COVID contracts rolling off. So that's why we see Q3 and Q4 dipping. This was all talked about in 2 cloud videos ago. Then going forward, I'm using a 4% per quarter revenue growth. So that's 17-ish compounded, 17 or 18 compounded over the year going forward. For digital health services, I've got the 2 pieces. I'm using a 3%, I believe, growth rate on the other part of digital health services. And then the Vision Pros, I'm taking a year to ramp back to the 7 million that we had in Q4 2021. So that gets me to about 10 million in per quarter at the end of next year. Clinics and pharmacies, they were around 10 million, or assuming by next year they might grow to around 10 million, taking off 2.5 million for the clinic and pharmacy sales. Definitely a little curious about whether I'm missing some more lost revenue here, but this is my projection now until I get more information. And then I put I think 2% per quarter growth rate on that. Now I built all these models, and then it ended up coming out that my projection was almost bang on Rob's projection at Echelon Capital, which gives me some confidence I can't be totally off here. If my model had come out much higher than his, then I would have been looking at these clinic and pharmacy revenues as maybe being overly optimistic. My 2022 projections are about 2 million less than Rob's. Certainly there's so many estimates here and guesstimates. I'm reasonably confident that my numbers are going to be close to what might come out. And definitely more optimistic about the company seeing this about 175 million in revenue next year. Big thing is, will it be EBITDA positive or cash flow positive? So they can preserve all the cash that they currently have. So the revenue, I'm a bit more excited, but the company, you throw in cash flow positive and I'm a lot more excited. Just a few things to wrap up with, updating that enterprise value and cash burn. Their cash burn was 17 million in Q2, but they said their normalized is about 7 and hopefully, or should be falling. So if we use a 7% cash burn, they've got 29.7 million of cash or cash equivalents. And what I didn't pay attention to before is their long-term, or their debt. 25 million is long-term and 3 million is due this year. So that's not going to be a problem. They've got more than enough cash to handle their requirements this year. So putting all that together, they have had about 30 million on the balance sheet. They sold a little under $10 billion worth of assets. Their burn rate was 7 million in Q2. So if I assume that's the same burn rate, they should have about 33 million of cash going into Q4. including the cash that they're going to be getting in Q4. I would assume they have the well money already and not the Neighbourly money. So they do have more cash than their total debt, but obviously this cash will be going down until they're cash flow positive. But in a reasonable position, particularly if they become cash flow positive, or even if their cash burn is $1 million per quarter, they're going to be okay. So their enterprise value, their market cap is about 67 at 22 cents, I believe, 33 million in cash and 28 million in debt. So their enterprise value is going to be a little less than 72 million as of today, because they'd have some Q4 cash burn, which would drop that a little bit. So enterprise value of about 70 million. So hopefully you found Rob's numbers and my updated numbers helpful in terms of understanding this company and modeling it going forward. If you do like this video, please like it and subscribe. And again, please comment on where you think I can improve the model. There's always going to be improvements needed, and the comments I get do help me focus in on where I've made small errors and where I should follow up with more research.